The markets woke up today with a palpable sense of renewed optimism, painting the major indices green across the board. The broader S&P 500, tracked by SPY, edged up a respectable 1.15%, closing at 685.40. Not to be outdone, the tech-heavy Nasdaq, represented by QQQ, surged even further, gaining 1.35% to hit 616.28. But the true star of the show, signaling a broader risk appetite and perhaps a rotation, was the Russell 2000, or IWM, which rocketed up an impressive 1.98% to 267.79. This kind of broad-based rally, especially with small caps leading the charge, often suggests investors are feeling brave, willing to step out further on the risk curve. What's fueling this surge? A quick glance at the fear gauge, the VIX, tells a significant part of the story. The VIX plummeted a staggering 15.88% today, settling at 16.90. When fear evaporates at this rate, it's like a gust of wind beneath the wings of risk assets. The air just got clearer, the path ahead, for now, seems less turbulent. This isn't just a flicker, it's a pronounced shift in the market's psychological landscape. But what's really driving this change in atmospheric pressure? Let's dig deeper into the voices shaping our financial world. The narrative shaping today's market is a tapestry woven by powerful voices, each contributing a thread of influence and insight. Let's start with former President Donald Trump, a figure who never shies away from economic commentary. He's been out touting extraordinarily high economic growth, and even claimed inflation was defeated. Now, while some economists might disagree with the defeated part, his rhetoric certainly adds a layer of confidence, or at least a powerful suggestion of it, to the economic outlook. This kind of talk can certainly boost sentiment, especially amongst those who feel his policies align with growth. And he's not just talking. Trump reportedly reached a framework deal on Greenland and dropped a tariff threat, showcasing a willingness to engage in deal-making that can ease geopolitical tensions and provide a clearer path for trade. Shifting from the political stage to the central banking arena, Jerome Powell, the current Fed chair, remains a central figure. Reuters polls suggest the Fed is poised to hold rates through March, and potentially even through Powell's tenure, on the back of strong growth. This kind of stability in monetary policy is a powerful signal. A predictable Fed allows businesses and consumers to plan with greater certainty, fueling the risk rally we're witnessing. Trump, ever the showman, has even signaled he has a favorite for Fed chair, down to maybe one, keeping the market guessing about future leadership, though for now, Powell's influence is paramount. Across the Atlantic, ECB President Christine Lagarde offered a stark counterpoint to the generally positive sentiment. She reportedly walked out of a Lutnick speech in Davos, critical of Europe, a dramatic gesture that speaks volumes about underlying concerns regarding the European economic landscape. This is a subtle yet significant detail, hinting at potential headwinds that aren't quite as rosy as the US narrative. Adding to this, the ECB's Nagel warned that US tariffs could force an interest rate rethink, connecting global trade policies directly to European monetary policy. This underscores the interconnectedness of our global economy. Now, for the corporate titans. Elon Musk, the enigmatic CEO, is always making headlines. Today, the focus is on what's going on with Elon Musk and Ryanair. A curious pairing that hints at potential new ventures or perhaps even a humorous social media exchange. While the specifics aren't clear, Musk's presence consistently generates buzz and speculative energy, which often bleeds into the broader tech sector sentiment. His companies, particularly Tesla, thrive on this kind of innovative, often disruptive, narrative. Jamie Dimon, the veteran CEO of JP Morgan, weighed in with rare criticism of Trump's immigration policy, stating, "I don't like what I'm seeing." This is a significant statement from a respected financial leader, highlighting how social and political policies can have real economic implications, especially for labor markets and broader economic growth. It reminds us that markets aren't just about numbers, they're about people and policies. The AI revolution continues to dominate discussions, and Nvidia CEO Jensen Huang, a figure at the epicenter of this surge, is pushing back against fears. He says, AI won't be the job killer everyone fears, offering a vision of augmentation rather than replacement. This optimistic take from a key player provides reassurance and justification for the massive investments pouring into AI. However, Big Short investor Michael Burry, known for his contrarian views, sounded an alarm, warning of an AI bubble that's too big to save. This stark contrast, one of the industry's biggest proponents versus a renowned skeptic, perfectly encapsulates the current debate around AI valuations. It's a tension the market will continue to grapple with. Investment legends also shared their wisdom. Warren Buffett offered timeless advice. Do not save what is left after spending. Spend what is left after saving. It's a fundamental principle of financial discipline that transcends market cycles. And Cathie Wood, the ARK Invest visionary, is reportedly bargain hunting with 3 stocks she just bought, suggesting she sees opportunities amidst current valuations, aligning with the risk-on sentiment. Finally, a quick mention of some other influential figures. Larry Fink of BlackRock and Ray Dalio of Bridgewater, both speaking on the global order and geopolitical risks, including Trump's diplomatic overtures. Dalio warns the global rules-based order is gone, as Trump threatens Greenland, a sobering thought amidst the current market euphoria. Michael Saylor, a prominent Bitcoin advocate, continues to champion digital assets, asserting that digital credit is volatility engineered. These diverse perspectives remind us that while the surface may appear calm, powerful currents are always at play beneath. Let's turn our attention now to the traditionally more subdued, yet incredibly influential, world of bonds. The US 10-year Treasury yield, represented by TNX, experienced a significant dip today, falling 0.98% to settle at 4.25%. A declining bond yield often signals investor confidence in the economy, or a belief that inflation pressures might be easing, reducing the need for higher yields to compensate for future price erosion. It also can reflect a flight to safety, but given the VIX plummeting and the equity market soaring, it's more likely the former, a sign that investors are less worried about aggressive rate hikes. This movement in bond yields ties directly into the inflation data that continues to make headlines. Trump's assertion that inflation was defeated might be an overstatement, but recent data does show a mixed picture. The crucial US inflation CPI report is always a market mover, and while some economists disagree with Trump's definitive pronouncement, the market's reaction suggests that the inflation narrative might be cooling. This perception of moderating inflation, combined with the Reuters poll suggesting the Fed will hold rates, reduces the upward pressure on yields. However, the global inflation picture isn't uniform. The UK provided a counterpoint, with UK inflation rising for the first time in 5 months to 3.4% in December. This divergent data could lead to different monetary policy paths for the Bank of England compared to the Federal Reserve, potentially impacting currency markets and global investment flows. For now, the US bond market seems to be taking its cues from the domestic inflation outlook and the Fed's steady hand. The central banks remain the ultimate architects of our monetary environment. In the United States, the Federal Reserve, under Jerome Powell, is walking a tightrope. The market widely anticipates the Fed will hold interest rates through March, and potentially for the entirety of Powell's tenure, as suggested by the Reuters poll. This expectation of stability is a bedrock for market optimism, allowing capital to flow into riskier assets without the constant fear of rate hikes. Strong growth figures, despite Trump's mixed picture assessment of US GDP growth, are giving the Fed the breathing room it needs to maintain this stance. It's a delicate balance: acknowledge growth, manage inflation expectations, and maintain market confidence. Across the Atlantic, the European Central Bank, ECB, faces its own set of challenges, some of which seem more acute given Lagarde's pointed exit from that Davos speech. ECB's Nagel specifically highlighted that US tariffs could force interest rate rethink. This is a critical point. Trade protectionism from one major economic bloc directly impacts the monetary policy levers of another. If European economies are hit by tariffs, the ECB might be compelled to consider rate cuts or other accommodative measures to stimulate growth, even if inflation remains a concern. This illustrates how global politics and trade wars can override purely domestic economic considerations for central bankers, adding layers of complexity to their decision-making. The disparity between the relatively stable US Fed outlook and the potentially more turbulent path for the ECB adds a key element to the global financial landscape. Commodities, often seen as a barometer for global economic health and geopolitical stability, displayed a relatively stable performance today amidst the broader equity rally. Gold, the traditional safe haven, saw a modest increase, with GC equals F inching up 0.09% to 4,836.20. Even with the VIX dropping and equities soaring, a slight uptick in gold suggests a lingering undercurrent of caution or perhaps a hedge against lingering geopolitical uncertainties. Ray Dalio's warning that the global rules-based order is gone, and Trump's diplomatic maneuvers certainly contribute to an environment where investors might want a small portion of their portfolio in a time-tested safe asset like gold. Oil, represented by CL equals F, saw a slight pullback, dropping 0.33% to 60.42. This marginal decline could be attributed to a variety of factors, perhaps easing supply concerns, a slightly stronger dollar, which makes dollar-denominated commodities more expensive for international buyers, or just profit-taking after recent movements. Given the overall risk on mood, a larger drop might suggest demand concerns, but this slight dip is more indicative of market noise rather than a major shift in the oil narrative. It's a reminder that not everything moves in lockstep with the equity markets, and individual commodity fundamentals often play a significant role. The dollar index, DXY, NYB, remained flat at 98.76, while the euro against the dollar, EUR/USD equals X, saw a slight decrease of 0.26% to 1.17. A stable dollar amidst a global risk-on environment suggests that while investors are moving into equities, they aren't necessarily abandoning the greenback. The euro's slight weakness against the dollar could be linked to the underlying concerns about the European economy, potentially amplified by Lagarde's actions and Nagel's comments about potential impacts of US tariffs. It reinforces the idea that Europe might be facing more significant economic headwinds than the US currently. Let's dive into the sectors that are truly driving this market narrative, particularly in technology. Nvidia, NVDA, was an absolute powerhouse today, soaring 2.95% to 183.32. This performance comes directly after CEO Jensen Huang's optimistic outlook, where he proclaimed that AI won't be the job killer everyone fears. His vision of AI as an augmentative force, rather than a destructive one, fuels the massive demand for Nvidia's chips, which are central to almost every AI development. This positive sentiment, however, exists in tension with Michael Burry's stark warning of an AI bubble that's too big to save. Investors, for now, seem to be siding with Huang's growth story. Tesla, TSLA, also had a stellar day, jumping 2.91% to 431.44. While Elon Musk's Ryanair dealings might be a quirky headline, Tesla's core business continues to capture investor enthusiasm. It's often a bellwether for speculative growth and risk appetite, and its strong performance today aligns perfectly with the broader market's move into riskier assets. However, not all tech giants participated equally. Microsoft, MSFT, took a surprising dip, down 2.29% to 444.11. This stands out against the broader tech rally. It could be profit-taking after recent gains, or perhaps specific concerns about a particular business segment or competitive pressure. Even the giants can have off days, reminding us that individual company performance is always a factor, even in a strong market. Apple, AAPL, and Amazon, AMZN, saw more modest gains, up 0.39% and 0.13% respectively. These behemoths often move with a heavier inertia, but their positive, albeit small, contributions still underline a generally favorable environment for large-cap tech. Beyond tech, we're seeing specific stock movements based on analyst upgrades and company-specific news. PepsiCo, PEP, was upgraded to overweight by JP Morgan, citing initiatives to boost shareholder returns, which sent its stock higher. Bristol Myers Squibb, BMY, also received an upgrade to buy from UBS, who noted a skewed risk-reward ratio for the stock. Autodesk, ADSK, was rated by Rothschild, seen outgrowing its end markets. These specific upgrades highlight that even in a broad rally, fundamental analysis and company-specific catalysts continue to drive individual stock performance. And for those watching the fringes, Riot Platforms stock earned a 92 rupees rating, suggesting strong relative performance, linking into the broader crypto narrative we'll touch on next. Finally, a general headline about why Advanced Auto Parts stock was sliding today reminds us that not every story is positive, even in a bull market. Individual company struggles and sector-specific headwinds are always at play. Our journey wouldn't be complete without a visit to the dynamic and often volatile world of digital assets. Today, the crypto market generally mirrored the broader risk-on sentiment we saw in equities. Bitcoin, BTC/USD, edged up a respectable 0.53% to 89,850.87, while Ethereum, ETH/USD, gained 0.92% to 3,006.18. These aren't explosive gains, but they signify a continuation of positive momentum, especially considering the recent volatility. Michael Saylor's observation that digital credit is volatility engineered resonates strongly here. The crypto market is inherently designed with high degrees of price fluctuation, and investors embrace this for the potential outsized returns. The current environment, characterized by diminishing VIX and a general embrace of risk, creates fertile ground for cryptocurrencies. As Cathie Wood goes, bargain hunting, in traditional equities, it wouldn't be surprising if her broader investment thesis on disruptive innovation also translates into a continued bullish view on select digital assets, particularly those seen as foundational. The performance of these leading cryptocurrencies suggests that despite regulatory uncertainties and some skeptical voices, a segment of the market views them as legitimate growth assets, benefiting from the broader risk appetite. As we look towards the next trading session, the stage is set for continued market dynamism. We'll be closely watching the impact of new economic data, particularly any updates on inflation or employment that could shift the Fed's carefully constructed narrative. Remember, while Trump may have declared inflation defeated, the actual numbers and economists' consensus will guide the Fed's next moves. Geopolitical developments, especially involving Trump's diplomatic overtures and any fallout from potential U.S. tariffs impacting the ECB, will remain crucial. These global currents can quickly shift investor sentiment, as Ray Dalio so eloquently warned about the changing global order. Keep an eye on the bond market. Any sudden reversal in the 10-year yield could signal a shift in inflation expectations or a renewed flight to safety. In the corporate world, the AI debate will persist. Will Jensen Huang's optimistic vision of AI integration continue to outweigh Michael Burry's bubble warnings? Nvidia's performance will be a key indicator. Also, watch for Cathie Wood's latest buys. Her movements often signal emerging themes or value plays within disruptive innovation. Any further clarity on Elon Musk's activities or Jamie Dimon's continued commentary on social policy will also provide valuable insights into the broader economic and social landscape that inevitably impacts markets. However, beneath this bullish surface, important questions linger. Is Trump's declaration of inflation's defeat premature? Will the ECB's path diverge significantly from the Fed's due to geopolitical pressures? And while Jensen Huang paints a rosy picture of AI, Michael Burry's bubble warning reminds us to tread with informed caution. These are not contradictions, but rather the essential components of a complex, evolving market narrative. Your job, as a shrewd observer and participant, is not to simply react to headlines, but to connect these dots. Understand the interplay between central bank policies, inflation data, geopolitical events, and the innovative spirit of corporate titans. The market isn't just a collection of numbers. It's a living, breathing story, shaped by human decisions and aspirations. Stay informed, stay analytical, and always keep learning. Video outro music begins.